And that's the argument I'm trying to make here. If you consider physical gold itself as an insurance class and other precious metals related assets like high quality gold stocks as investments, the performance that you get out of this sector means that a fairly small proportion of your portfolio fulfills the insurance function that gold has filled for investors for 2,000 years. And that's what I'm advocating.
Greetings, finance enthusiasts. We're welcome back Rick Rule for this deep dive where we'll analyze the nuances of a liquidity squeeze and its impact on the financial landscape. Join us as we navigate the risks and implications, aiming to arm ourselves with insights to navigate these uncertain waters. Stay tuned as we unravel the complexities and implications for portfolios and markets alike. So, keep watching till the end of the video.
I hope not too many of your listeners are part of this group. There's a whole generation of Americans whose thoughts of the future were generated by the last 40 years, a period that was very benign with lower interest rates. And this whole generation of Americans, among other things, has turned into what I so inelegantly call yield whores. People who buy investments based on the amount of distribution it gives them to sustain their current lifestyle. And many of these people have been lured into so-called high yield ETFs. Mm-hmm. And these high yields are obtained by taking short-term credit risks. You have these high yield ETFs that are extremely liquid and are owned in $10,000 or $20,000 chunks by middle America. The problem is that the underlying assets, over-the-counter bonds, are highly illiquid. And if we have any of the sort of constrained credit market that you describe, if we have the sort of liquidity squeeze that we had in 2008, which I don't think is unlikely, and you have middle America bailing out of these high yield funds, which are very liquid, and the fund manager trying to sell the underlying assets, which are highly illiquid, what's in their portfolio and what assumptions went into buying it? If the whole assumption was yield, you need to wonder what the probability is that you continue to enjoy that yield in the next 10 years, where the circumstances that you're confronted with are very different than the circumstances that you were confronted with over the last 40 years. When we went into 2008, government debt, on balance sheet, not off balance sheet, on balance sheet liabilities of the U.S. government were about 25% of GDP. In other words, the government still had the ammo to push on the string. Recourse liabilities of the government now, full recourse, which is to say on balance sheet liabilities of the U.S. government, now exceed 100% of GDP. Mm-hmm. So the necessary ability of the government to print and spend their way out of a circumstance is materially diminished. I'm not trying to say that the confidence in the U.S. economy doesn't exist to the extent that they wouldn't be able to do it, but it would be much, much, much more challenging from my point of view, just because of simple arithmetic. Debt as a percentage of GDP has quadrupled, which means that the financial flexibility has probably declined concomitantly. Now, necessarily needs to include gold and precious metals related investments in the conversation. I am fond of saying I don't own gold because I think it might go from 2,000 to 2,200. I own gold because it might go to 6,000 or 7,000 or 8,000. Mm-hmm. I remember well the period 2000 to 2010. Gold at the beginning of that epoch had been written off completely, and it was selling for $250, $260 an ounce. By the end of the decade, it was selling at what, $1,850 an ounce? An even more impressive statistic, I think, is that in the face of what I see as society being between the rock of higher nominal interest rates and a liquidity crisis, that the market share of gold and precious metals related assets is less than 0.5%, which is to say 0.5% of all the savings and investment assets in the United States are in precious metals or precious metals oriented assets. The 4-decade mean, according to JP Morgan Chase, is 2%. JP Morgan didn't have access to the statistics, but they estimated that it was between 5 and 6%. But let's throw that out as an outlier, just for fun, because we don't need it for our argument. If precious metals reverted to mean, demand for them would quadruple. And that's precisely what I think is going to happen. If you assume that prices are set on the margin between supply and demand, not aggregate supply and aggregate demand, what you say is true. But again, I don't need that to make my argument to your listeners. I just need to say that most Americans need to own more of it rather than less. And the consequence of that is that a price target is higher, not lower. I don't think that investors, unless they're extremely knowledgeable and extremely hardworking, should be overinvested in precious metals. Because the truth is, it's an insurance policy where a small premium buys a fairly large payoff. A circumstance where 10% of your net worth is in precious metals and precious metals related assets. If past its prologue with regards to the price performance of these assets during tough economic times, the performance of this 10% of your portfolio in precious metals will offset, if not eliminate, the deterioration that you would see in a whole host of other asset classes. And that's the argument that I'm trying to make here. If you consider physical gold itself as an insurance class and other precious metals related assets like high quality gold stocks as investments, the performance that you get out of this sector means that a fairly small proportion of your portfolio fulfills the insurance function that gold has filled for investors for 2,000 years. And that's what I'm advocating. I think that one doesn't probably use that as a crutch. I think that you need to maintain liquidity in your accounts in addition to having gold. Although, as you point out, gold is superb as a form of liquidity. It's a volatile form of liquidity. And for it to be liquidity, you have to be willing to sell it to buy a different asset class when everything else collapses. I want to return to the fact that it doesn't take a lot of gold. It just takes some gold to provide insurance that you're talking about. And most people don't get that. Or if they do get it, most people confuse themselves with the form that they buy gold in. As an example, although I made the money that I now invest by speculating in exploration stocks, owning a gold exploration stock is not the same as owning gold. The gold exploration stocks are looking for gold. They don't have any. And precisely the point is that you begin your gold investing journey, the gold portion of your portfolio, by owning gold, by owning the stuff. By all means, then, once you've covered the insurance part, invest. Buy the good gold stocks. And if you're willing to work hard and take risks, and if the rest of your portfolio is covered off prudently, then by all means, speculate. Just don't confuse the three activities: insurance, investment, and speculation.
As we conclude our exploration of the potential repercussions of a liquidity squeeze, remember that knowledge is your strongest asset in navigating volatile markets. If you found this discussion insightful, don't forget to like, share, and subscribe for more in-depth analyses. Thank you for joining us today, and until next time, stay informed and stay ahead in the world of finance.